Now, the point of today's podcast is a timely one, as we're going to be talking about the recent U.S. government shutdown. We're going to talk about why it happens, what it means, and more importantly, what effect it may or may not, spoiler alert, have on the markets. So let's start from the top. What is a government shutdown? Well, a government shutdown occurs when Congress fails to pass the necessary legislation for the upcoming fiscal year. When this happens, we see non-essential agencies get closed down, and we see non-essential agencies get closed down, government agencies get closed down, and we see non-essential employees get furloughed, meaning they are released without pay until a funding agreement is agreed upon. Now, for everyday people, normal folk, right, this can be a really big deal, right? Millions of families may go without paychecks, government services get delayed, there's a whole flight thing going on right now. But more importantly, uncertainty about your future creeps in. And that's very important. But because this is the Trading Coach podcast, we're going to take a look at this from a trading perspective. And from the market's perspective, at least historically, shutdowns really don't move the needle much if they are short-lived. And again, this is something that we'll revisit later because that's a very big if. So just to kind of emphasize this point, hopefully I'm putting up a pretty cool chart that goes along with it. If I haven't done that already, I don't plan this in advance. But we've had 22 shutdowns since 1976. And the market's reaction has been pretty random, right? Sometimes it sells off, sometimes they rally, sometimes they do absolutely nothing. And so far, this time around, the reaction has been kind of, this is a technical term I'm about to use, so write this down, meh. Now, with that being said, this time might be different, and here's where things get a little bit interesting.